All right. Well, thank you, Mo, and thanks everyone for joining us today. We titled this webcast or webinar Seeking Income in an Evolving World, as it's really always top of mind for investors on how to generate income and get some stability in that income. And unfortunately, I recycled the graphic here, and I was calling it the cross currents because this was from a couple of weeks ago, and that's why you see the raft on there. So please don't think the raft and those large rapids have anything to do with the volatility of the income. So what I'd like to do is just kind of remind everyone kind of what the U.S. economy looks like and what it's looked like over the last like 14 or so years. And why I like to point this out is because we've had a lot of volatility since the pandemic. But if you look at how eerily stable the world was from 2010 to 2019, this kind of gives you a sense of where the economy should be headed, right? This is what we call, in economic speak, we call the potential of the economy. But you notice there's two big aberrations here. There was obviously the 2020 hit due to the pandemic, and then its ensuing rebound. And as Mo said at the beginning, those rebounds were induced by both monetary and fiscal stimulus. And so what you see there is an evolution of the economist forecast. And you can see economists, even though they're trained professionally, they have trouble getting what the final result is right. Obviously, it converges as we get closer and closer to the full year. But what you notice in these charts, and forget kind of this evolution at the early onset of these forecasts, but look at where we are in 2022, where we ended. Look at 2023 and look at what we're forecasted to do in 2024. And I remind everyone that we have 7 months under our belt in the economy. So the forecasts are getting better for the overall year as over half of it has passed. But notice where those endpoints are. They're very similar to where we were in the pre-pandemic environment. So that's what I call the post-GFC, the global financial crisis, and the obviously prior to the pandemic. And so obviously there was a big hiccup in the economy. That's where policymakers, both our elected officials as well as the appointees of the Fed, try to help stabilize markets and the economy when things fall out of bed. But you can see kind of that visceral reaction of you get this very strong growth out of the other side, but ultimately you'll converge back to potential. And this is important for investors because there's been so much talk of a recession. There's been so much talk about how bad the economy is, how bad manufacturing is, the state of the world in the US. And I have to remind everyone that it's kind of like it has been for the last 15 years. So that being said, enjoy yourself. Let's generate some income and let's enjoy our lives, okay? So said differently, here's another way of looking at this, and this is reflective of the post-World War II era. And so what we do here is we show the growth of the economy. You can see that squiggly line over time. It's on a logarithmic scale. So what that means is that the slope of the line is actually the growth rate. And that way, when it compounds out, you can compare years to years on here. But notice how relatively stable that growth rate was until approximately 2008. Well, something happened in 2008, right? We had a global financial crisis. The US was the epicenter of it. Our housing market was the epicenter. And obviously that had some drag on GDP. But also notice what happened to the slope of that line. And I promise this is as mathematical as I'll get today. I do have a couple of degrees in math, but this is as mathematical as I'm going to get. But notice what happened to the slope of that line. If you just look at my hand, it flattened out somewhat. That means the growth rate post-global financial crisis has been lower, right? So don't expect us to get back on that dotted line trend. But then what we also show is a red dotted line there that shows how eerily stable the annual growth rates have been, or the growth of the overall economy. So what we'd like to remind people is even with that big dip down we saw in 2020, we're back on track to essentially this growth rate, which is approximately 2.3 to 2.4% per annum. Guess what? That is healthy. That is good. And that is what is driving our economy today. So I like to have some sanity checks here. A lot of times we focus on the blips on the screen and we get too caught up in the minutia of markets and forget that even when the market went down 2 weeks ago, right, the economy was still doing okay, right? So I just want to reinforce that. So let's take a look at what the market or how forecasters are thinking about this. And so these indices are what we call the surprise index. So what it does is it takes a survey of economists and what their expectations are for the economy, and then it compares it contemporaneously to the hard data that comes out. So when the data comes out, is it above those expectations or below? And notice here what you see in that red line. Look at the US. During the entirety of 2023, it delivered above expectations. You probably all remember the recession calls that were ad nauseum during that period of time, right? But now it's how kind of markets work. By the time we get geared into it and start thinking that things are going to be better, all of a sudden we get a little bit of a reversal. And so the surprise to the downside just means that the data is delivering below expectations, but it doesn't mean that we're mired in some form of recession. And you can see that the outlier in 2023 was the US, right? There was a lot of people coined the phrase US exceptionalism. A lot of people look at our stock market and will use that phrase as well. But really what you see is that the economy held together very well, even though we had this significant monetary tightening through the Federal Reserve's interest rate policy. And what the Fed was trying to do was trying to tighten the conditions. So it's kind of a messy chart, but it shows you the inputs that go into something called a financial conditions index. So it uses all of these measures on here, things like volatility, credit spreads. It does a bond market volatility, stock market volatility, and it pulls this all together to say, okay, are conditions accommodative or are they tight? Now, look at in 2022. The index was giving you a tight reading, right? The Fed was really hammering on the brakes of trying to slow things down. They were trying to fight inflation. But notice what's happened since the Fed kind of normalized policy. Conditions have actually stayed somewhat accommodative. Now, this doesn't mean that the Fed should stay at their level. And we saw the inflation report come out today, and a lot of bond market aficionados cheered that data. But this is to say that conditions are pretty easy. That is, spreads are tight on corporate product, right? There is somewhat a lack of volatility in the marketplace, or at least it's below average. And more importantly, the conditions are set up for the economy to still continue to function. Now, this doesn't mean that the Fed should not cut interest rates. In fact, the Fed should cut interest rates because they are significantly tight relative to kind of the inflation print, which they're trying to target. And so why I point this out is that, as much as we saw the volatility from 12 days ago kind of leak through the markets and people got very fearful in the market, there still are pretty good overall aggregate conditions. And so this is because, again, borrowers are able to access capital. The capital markets are indeed functioning. And so now let's get into the economic data. And so I've heard this for a long time. There's a flippant phrase that people will use. They'll say the U.S. does not manufacture anything. The U.S. doesn't create anything. And it's not true, first of all. We have about 11 to 12% of our economy comes from manufacturing. And we are, with the CHIPS Act and things, we're probably going to do a little bit more going forward. But this is where some of the forecasters got it really wrong. And notice this PMI, if it's below the dotted line, that says that it's kind of a contractionary measure versus above the dotted line is an expansionary measure. And notice what's happened during these periods. When we get the recessions, both of these series tend to go below that dotted line. And that's the one thing that's been missing during all these calls for the recession is both series have not been consistently below the line. We've had a couple of head fakes on services. You see that in late 22, and we got a little bit a couple months ago as well, but we've rebounded back. And so why this is important, because we are a service-based economy. And I'll show you with the inflation data, that's what's driving the inflation right now. It's that we cherish more of doing things and being a society that services one another than necessarily a consumption-based manufacturing type of economy. And usually those usually go in concert with aging demographics as well. But also, if you look at like the export and import data, this is another way of thinking about inflation, because it just says, what's the price? And this doesn't have all these wonky economic adjustments, what we call hedonics in the art of economics. But what it does is actually just measures prices. So this was a very good gauge to be able to see where the inflation was coming from. right? We were importing it as well as exporting inflation at that point in time. It was a global phenomenon. I know people like to get very political and blame the other tribe that they don't belong to when it comes to the inflation and whose fault is it. But this is actually a global phenomenon. The coordination of central banks around the world slashing interest rates, the amount of fiscal stimulus that countries did across the globe, and by the way, we shut the world down. Don't forget, we had a global pandemic that really grinded things to a halt. And that's what caused some of this price spike. And another way of thinking about this activity is that similar to the series, the series I showed you on services and manufacturing was the overall aggregate economic activity, but there's subcomponents. And with one of those subcomponents is prices paid. And if you look here, the manufacturing prices paid, they continue to go up. Right now, they're not up as much, not as many people reporting up as before. But notice the services still has this kind of inflection point of higher cost of services. This also is leading to why we have inflation being a little stickier when we talk about this kind of last mile of inflation down to the 2% path. And so this report, actually, this red line here is what got the bottom in equities last Monday. This report came out at 10 o'clock Eastern, and when it did, the bond market calmed down, equity volatility dropped, and you got a stock market rally. Because it was like, okay, even though the jobs data may have looked a little poor, there's some weakness in that report, services and consumption is still there. So it's very important to remember what drives our economy. And unfortunately, this chart's not updated because Mo makes us get everything in early so we can be very compliant, and we're a culture of compliance. But what's important about this chart is to show what is driving inflation. And I've always looked at this in kind of three broad strokes. What we call goods, the things we consume, right? Services, and services are the things we do, like dining out, and also living is one of them, and that's shelter. Shelter's a piece of that, so you have to strip that out. But notice that big, that light blue area. And what this is that what we take here to do this is we say, what is the weight of shelter in the CPI measure, and multiply it by the actual inflation rate that you're seeing in shelter, and you put those together, that product. I told you there'd be no more math, but this is simple multiplication. And what that does is that gives you its contribution from that category to the overall measure. So if you notice that black line, which is CPI, it's the sum of the three colored bars. And notice what's happened here is that all of a sudden, we got this meaningful shelter inflation, right? Has anybody looked at the price of housing lately, right? It's up meaningfully from the beginning of the pandemic, right? That's because there was a lot of wealth created during the pandemic. You may not feel that way, but we printed a lot of money in this country, and it has to find a home. It finds it in assets, and one of them happened to be houses, because we were so clamoring for more space, and this was our new life, the new normal of just always being at home. But also look what happened in 2021. That dark blue bar, which is goods, right? Look at how big its contribution was to inflation. And notice how it is dissipated. In middle of 2023, last year, as that inflation rate came down, goods inflation, once the supply chains got resolved and there was the backlogs worked through, it took a couple years. But notice that all of a sudden it disappears. And now today, what you see in 2024 is goods is actually deflationary. So the goods component is actually contracting in CPI. And in fact, in today's report, it's even more negative today than it was in the June report. And so what you find here is that the big piece of inflation is still coming from the shelter component. The good news that I can tell everyone is shelter, how it's calculated in the CPI measure, operates with a meaningful lag, typically about 6 to 7 quarters of lag. So what you'll see is that this should continue to taper down, which puts the Fed on its glide path to be able to start its rate cutting cycle at the September meeting. But notice there's still that services. Notice how those bars are a little bit bigger than they were pre-pandemic. And I think this is part of the idea where you've heard the narrative that we do things versus consume things, right? We want to have experiences. And, kind of prior to the pandemic, it was mainly a younger generation thing. The younger generation was the one that wanted to do things and have these experiences over the traditional goods consumption. But then we all did it, right? Because we were all stuck at home for a prolonged period of time. So anyway, why I point this out is that notice the black line is decelerating. The bad news for everyone, and this is what is really rough, is that prices aren't going to come down though. That is the bad thing. So even though the cumulative inflation rate is like 22% since the pandemic, the price levels will not come down. Why? The Fed will not allow deflation to be prolonged and persistent because you get in a price decline spiral. If you believe prices are going down over the next month, you are incentivized to defer consumption. And this kind of gets us in that downward trajectory spiral there. So unfortunately, that's what we're stuck with. But the good news is that the rate of inflation is not really accelerating. It's decelerating from the levels it was coming at. So, Jay Powell came up with this idea of super core. I never liked the idea, like strip everything out that you don't like and you get a more managed number. But this was something I looked at. And if you're like us and you really enjoy those Fed conferences, every 6 weeks when they come out and you sit on the trading desk with us and you eat your lunch and you're cheering for Jay or you're rooting against him. This is a measure that you haven't heard from him in 9 months. I wonder why. Well, when he was doing it, it was decelerating. When he invented the term, it was decelerating. He's like, oh, this one's under control if we strip out shelter. But now he's got a problem. So my point with all this is that there's all these wonky measures, but at the end of the day, CPI is CPI, and we have to live with it. It's just, you need to understand what's driving it to kind of get a sense on where the economy is going. So here's kind of the what set things off 12 days ago. It's non-farm payrolls versus what's called the household survey. So we all celebrate this non-farm payroll number when it comes out. It's what we call the jobs report. It's also what we would call the establishment survey. You'll hear all those, they all mean the same thing. That's the red line there. And it actually goes and surveys businesses. It says, did you create a job this month? Or did you not? Right? So that's where we get the jobs number from. There's another survey that's done, and it's called the household survey. And the household survey is one where they ask people, and they don't say, how many jobs do you have? They say, are you employed or are you not? And if you're not employed, are you unemployed for economic reasons or non-economic reasons? And why I point this out, the unemployment rate comes from the blue line. So notice we've had job growth according to the establishment, according to businesses, right? But something is being missed, or there's a disconnect between the series. I won't say one's right or one's wrong, but what's happened over the last, I'd say, 4 to 6 months, a lot of economists have posited the idea that immigration is not being captured rightfully in that blue line, which leads to, again, because there's more immigrants than we had prior to the pandemic, it's just grown as a percentage of the overall working force. And so maybe they're not being appropriately captured in that data set. Again, the jury will be out, but it does make some sense, right? But we're growing 114,000 jobs last month, but the unemployment rate went up 0.2. What gives? It's that disconnect in these series. So we'll have to see. This is what set off the stock market sell-off, because the bond market has been on edge for all year. In January of this year, the bond market said the Fed is going to cut 175 basis points this year. It's going to cut every meeting. It's going to get to that. And then, whoops, inflation came back. It had to reprice. But once inflation started to curtail a little bit, the bond market say, here we go. Now we're going to get our rate cuts. And because the inflation has been tapering down, all eyes are on employment now. So I actually think the Fed doesn't care as much about inflation today. They are going to be myopically focused on these jobs data. And that's important because this is going to drive volatility on the days of those releases. So again, you as an investor, you don't need to worry about it. That's our jobs to worry about, what happens on days like this. But in general, what you actually see is that there is a big gap in these series, and it kind of explains why I can be right or I can be wrong, just depending on which data set I'm using there. And so I said, the another thing is, like, I've heard the narrative that we have so many part-time workers. There's so many part-time workers out there that's what's really happening. So it's a bad economy because people are working part-time. Well, this data series goes back to 1969, okay? Notice how many part-time workers there are. Notice that bottom panel in red. Notice the scale on that panel. There are 22 million people working part-time today. And notice what that label says in there, for non-economic reasons. It could be lifestyle choice. It could be you need to take care of the kids. You got to take care of an older parent. Maybe you just like working part-time. You don't want to be a full-time employee. So we're not judging, right? But notice this. If you look at that trend of part-time, outside the gap of it dropping down during the pandemic, it kind of looks like we're back on the path, right? As the population grows, the number of workers working part-time has grown as well. So notice the top one. This is the one that's more troublesome. This is people saying, I have to work part-time because I've been laid off. I need another job. I'm not making enough money. Whatever that may be, that is the one that's typically more troublesome. And notice it has went up lately. But now let me give you the magnitude. It's went up over the last year by about 500,000 people. That's really not a lot in the aggregate economy. So again, I know these make good narratives. It's good scare tactics when people say, oh, we don't make anything. You know, everybody's working part-time. No one can afford anything. It's just not true. Yes, there's haves and have-nots in the economy. There always will be. But in general, there's nothing different about the economy today, really, than what we saw in that kind of post-GFC pre-pandemic era. The bad news is the unemployment rate's going up, right? So I'll use the data. I just talked about why that is happening. And usually when it starts to usurp the 12-month moving average, that's usually when you have to go on recession watch. Now, we can take these time series back farther. And what you'd see is that you do get some false positives. That is, it triggers it, but it doesn't cause a recession. You may have, if you see the media these days, people are referring to something called the Somm rule. There's a woman economist named Claudia Somm who created this idea of the moving averages relative to unemployment. Once it goes above a certain level, that triggers a recession. And it's got a perfect forecasting record. So that rule was triggered 12 days ago, right? So we must have an imminent recession, right? Well, let's go to the source. Claudia was on TV that day when it came out. She said, well, it's just a statistical construct. You have to think about what the economic implication is. And if we're coming off a very low level, maybe it doesn't have as much forecasting power this time. Notice how low the unemployment rate was prior to the pandemic and what we've been coming off of as well. In the context of, kind of the aughts, right? The unemployment rate was meaningfully higher than it is today, right? And those were pretty good times. So again, it's easy for me to say I'm employed today. It's easy for me to say, don't worry about the unemployed people. It matters a lot more when you're one of them. But I do think that what you're seeing here is we're just coming off very low levels. So again, there's another measure you can look, and I like this one because it's not survey data. This is what we call the jobless claims. And jobless claims is like when you get laid off and you go to the unemployment office at your local state and you ask for unemployment insurance. That's a claim. So there's two series here. There's the initial claims, how many new people filed for unemployment insurance. And secondly, the continuing claims, how many people are continuing to receive benefits. So notice, you could argue that there is a little uptrend from the bottom in the middle of 22, but look how stable they've been for the last year or so. Maybe there's a little uptick in initial claims, but the continuing claims aren't growing, meaning that somehow they're transitioning. They may drop out of the workforce, right, which is not good, but they may be getting a job, right? And so just because someone got unemployment insurance, they're trying to get back in the workforce typically. So again, I like this data series because it's not a survey, it's actual claims at each individual state, and it gets aggregated up. Here's the other part where Jay Powell and the Fed really likes something called the JOLTS data. It stands for Job Opening and Labor Trends Survey. And this tells you how many job openings are, that's that blue line. And then, so if these are how many jobs we have available in the aggregate economy, and we have this orange line of people unemployed, well, if they're one for one, everybody should be able to find a job. Now, we know that's not true. It could be geographically undesirable. It could be that you're not qualified for that job, or maybe it doesn't fit, your economic needs. But in general, notice how there was this big gap that happened after the pandemic, right? That we had way more people looking for workers than people actually unemployed and looking for work. So this is what, when Jay Powell says the labor market's getting more in balance, this is the data he's looking at. He's looking exactly at this double line chart right here. Well, he's probably looking at the Fed's version, but you get my drift. Notice at the bottom, though, the job openings rates are decelerating. The hiring rate is kind of tapering off, although it looks similar levels to that post-GFC pre-pandemic level. And same thing with quits. Remember the, what was it called? The silent quitting? I think that was the phrase they used too. Quiet quitting. Yeah, it has to be alliterative. It couldn't be silent. It's quiet quitting. And that's where people feel confident. And so that's another sign of imbalance in the labor market. And so again, they think their prospects are better. So in general, these are looking more normalized. So I don't make a lot out of this and saying, oh, the labor market is falling apart. It's doing just like our GDP was. If you recall how I started this conversation off, it's getting back to those longer term trends, right? And so we worry if it dips below that, but for right now, we seem to be engineering back to that level we were before. And then you can also see wage growth here. This is average hourly earnings. I don't love average hourly earnings, but the Atlanta Fed had another measure. They discontinued it for the last couple of months because they're trying to tweak the data a little bit. But I don't like average hourly earnings because it doesn't adjust for the labor force. I think we all can agree in March of 2020, I don't think people got 8% raises, right? That just didn't happen. What happened is the lower end worker fell out of it, right? Because we're using aggregate earnings divided by the number of people. And so it's the lower end that dropped. So it made that come up. That's why you saw the big dip down when people came back to work, right? So again, but you've seen here that workers have demanded a higher wage. And look at where we are. I mean, we are at kind of still above where we were in that post-GFC pre-pandemic trend. So again, this is something that the Fed looks at because if wages are accelerating, that can lead to a wage price spiral. I like this chart here selfishly because I created it. But more importantly, what I was trying to do is say, how come people feel so bad? When I look at the sentiment data, why do people say the economy is so bad? And if I had to draw one chart with data, this is the chart I would choose. And if you look here, what we did, and I've meaningfully picked June of 2020 to start both of these series, okay? I did that because the aberrations in the data, we saw those big spikes up and down. But notice here, that red line is the cumulative inflation rate as measured by CPI. We can agree or disagree on that that's the right measure, but it's a number. That rate is 21.8%. That's the cumulative inflation rate. And look at what's happened to average hourly earnings. On average, we've grown at 19%. People are falling behind relative to inflation because of that gap in 22, right? If you look today, the CPI report came out, year over year, real wages are up 0.7%. So that wage growth is 0.7% higher than the inflation rate. So people are making up some of this ground, but the problem is it's a lot of ground to make up from 22. This is why I think that there's such negative sentiment out there and why people are complaining about inflation, even though it's getting more contained. And that's why I said these price levels aren't going back down. So you have to live with it. We're going to have to make some discerning choices. But in general, this is, if I wanted to sum up why people feel so bad, as I'm telling you the economy looks okay, it's this chart right here. And one other thing too, and Mo and I were having a little banter before we got on here. It's what we do. And, we were talking about, hard-earned money. And, we work hard for our money and we don't want to just frivolously spend it. But notice how the personal savings rates have went down meaningfully. Notice the big spike, right? That spike was the government mailing checks out. Okay, that's what happened there. But notice here that we're saving a lot less than we were in that little trend area. And this isn't a cumulative savings. This is just savings as a percentage of disposable income, which is coming out of your paycheck. So we are growing our savings rates, but it's a very low rate. And I think some of that is because of this chart. This chart right here, people say, I deposit my money at the bank. They put it in a savings account. You get a paltry interest rate. You get 0.0 something. And you're looking at this inflation. You say, you know what? I'm going to go do something. I think this is one thing that's been missed in this Fed hiking cycle is that the transmission mechanism of savings just hasn't really been there. And one, it's the banking system doesn't pass through rates. As I told Mo, I'm a Fidelity client as well. I'm part of the cult here. But you have a money market fund there. I put most of my cash in it, right? I get almost 5% today. It will likely come down over time as the Fed cuts rates, but I'm incentivized to save. But if I saw 0.00 something, I probably wouldn't have the same incentivization, right? So on to the bad, right? So it has to be, we're fair and balanced here when we look at economic data. And the bad is that delinquencies are going up. Now, delinquency rates on credit cards are pretty high today. The other is like personal loans, consumer loans, other things that are unsecured. But notice mortgage rates the delinquencies went up a little bit, but they're way below trend. Also, guess what? If you had a mortgage and you originated a mortgage, I don't know, 3 years ago, be delinquent. You know what? You can sell the house. No one's going to lose money in that, right? So it's not shocking to see why those are low. But autos are a concern. Autos tend to always be somewhat of a concern, but it's undeniable here that the delinquencies are going up. Delinquencies are a precursor to defaults, and so there is going to be some stress in credit. So this is probably also, if I took this data set and I tried to explain it on like cohort analysis, what you'd find is two things. This is primarily driven by the lowest FICO score, that is the lowest creditworthy borrower, and the lowest income strata. Okay, that's important because they are the ones that feel the impact the most of inflation. Inflation is regressive. It hurts people with lower incomes more than the wealthy, right? And so that's what you would see. A lot of this is coming from those individuals in those areas. So one thing why I think markets have still done relatively well is the money supply trend. And money supply, this is a weird concept from economics, but it's essentially the amount of cash in the marketplace. So it's checking accounts, savings accounts, money market funds. That's the definition. Notice what happened in 2020. We were on this like long-term trend here. And then all of a sudden, we increased the monetary base by 30%. 30%. We injected, as you see from this chart, over $6 trillion into our economy. Guess what? If you inject $6 trillion, guess what it does? It goes somewhere. Where did it go? I don't know. It probably went to crypto, right? It went into financial assets. It went into houses. It went into experiences. So this is what we call liquidity. This is the excess liquidity in the market. And why financial markets have been resilient in all of this is because this money had to find a home, right? And it found a home in our financial markets. People invested some of it. So this is why I don't think the Fed should be very concerned about liquidity in markets today, because again, this is a wash there. Now, maybe prices have to come down on some assets, but in general, this kind of explains part of why we got some of the inflation, but more importantly, why the markets have been so resilient over this period. The bad news also is that our budget deficit is unwieldy. We've written a paper recently. One of the members of my macro team put something out a couple weeks ago. You can go to the DoubleLine site if you want to look at it, but just talking about the fiscal tenability. And what I want to just draw your attention to real quick is notice what happens. Prior to the global financial crisis, whenever we have a recession, the budget deficit goes up as a percentage of GDP. Well, GDP goes down, budget goes up. That's what it looks like. But notice what happened in the last cycle. That we start to cure all the ills because we grow and we tend to not spend as much because we're saving for the rainy day. But notice what happened in essentially the 2014 period or the 2015 period. Well, we kept spending, right? We kept increasing the deficit even though times were supposedly good. So this is a relationship that doesn't look very good, and we continue to be on this path. This is not a doomsday scenario. This is not to say the U.S. is going to go through a depression or anything, but at some point we're going to have to deal with the burden of our deficits. And if you look, this is the average interest rate on treasuries today. So this is if you take the treasury stock that's out there, not held on the Fed's balance sheet, but actually in no intergovernmental transfers, just that's held in the public markets, the average interest rate is 3.4%. Well, that means you take that debt burden, that $30 trillion we have, and you multiply it by that, and that gives you what our annual interest payments are. Good news is the bond market has come down a little bit in terms of yield, so potentially that'll help this a little bit. But again, we're going to have some fiscal sanity and some austerity along the way. And this is what it looks like as the percentage of the overall revenue stream. So this is the actual interest rate payments that the government takes in dollars divided by the dollar of all tax receipts, right? And you can see the forecast here. They're looking to go off the chart. So something has to give at some point. But the good news is today's not the day. It's not something to worry about. It's something to worry about when we have the next financial downturn or economic downturn. And this is probably the reason that the Fed wants to cut rates, is because even though the inflation data is okay, the labor market, it's showing a little bit of wobbliness, but look at what small businesses are paying, because their loans are tied to the prime rate. Prime is tied to SOFR, which is prime is tied to Fed funds rate. And as they've been hiking, these are the people that have to pay the higher rates. And so this is probably another reason why the Fed has been thinking about maybe we are a bit tight, because small business does something like 60+% of the jobs in this country. So we need to see expansion here. If you, I don't know, sample your local communities. I don't see a lot of expansion. I see people surviving. I see businesses thriving, but I don't see a lot of expansion. And again, you can't make an economic decision on anecdotes, but to me, this chart is why that's the case, right? It's expensive. You're just trying to make ends meet. If you're borrowing at a 10% rate, it's going to cost some money. And that's why sentiment's bad in small businesses. And lastly, they're hiring less. That's the blue line, and it's correlated to the unemployment rate. So let's get to the markets real quick, because I promised income for this world. And so this is a measure, various measures of volatility. The blue line actually is the bond market. The black line is the stock market. And notice the bond market's been the neurotic one for the last couple of years. Why? Very low rates to more moderate or kind of normalized rates. So that caused noise, and you've had inflation. You just had a market on edge. Good news is that volatility is calming down. Now, granted, there's a big spike in the black line. If we updated that through this week, those numbers would have came back down normalized again. So we talked about income. Well, these are the various parts of the bond market. These are the performance, and these are not income figures. This is what the various segments of the bond market have done year to date through last Tuesday. And what you see here is that everything has a positive rate of return. Okay. Higher starting yields helps you. You can even weather that interest rate volatility. And you can see some things like commercial mortgages have done quite well. Well, if I showed you last year's performance, they did abysmally, or they were abysmal in terms of performance. So that's a reversal of that. But notice here, you've got, this is only, 7 months of data, 7 months and a week of data. You've got 2s, 3s, 5s, 6s, 9s on the board. Fixed income has been good for people. And secondly, think about the experience you had from the Fed meeting 14 days ago, the jobs report, to this meltdown in stocks on Monday morning at the open, right? What did bonds do over that period? They generated a positive rate of return for you. So it's acting as a more of a ballast in the portfolio. And so we just want to remind investors that bonds do serve a purpose in the portfolio. And look, the riskier the credit, the better the performance. The safety assets aren't doing as well. In fact, now if you update this a week later, everything has moved up a little bit too. So the bond market is performing this year. It's doing quite well. And again, you haven't missed the rally. Remember, there's two pieces to the fixed income return: the income you generate, and then how rates move around that and spreads move around that. But the easiest thing to analyze is what that income component is. And so you can see here that I said the bond market got neurotic. Look at that 2-year treasury. It was 0 back in 21. And obviously it's correlated to Fed funds rates. And look, we got over 5%. And we tested that again this year. And this morning it's a little inside of 4%. So, for people that have been sitting in cash, what this is telling you is that the bond market doesn't believe those cash rates are staying there for the next 2 years. On average, they expect you're going to get 4%, right? So enjoy your T-bill return today. But as Jay Powell and his committee cut rates, it's going to bring those T-bill rates down. So you need to think about ways of supplementing that income with something that can behave as a risk offset to the other parts of your portfolio. And strangely, even with all the kind of noise we've had over the last week, these yields are all roughly the same today. So we've kind of settled in these new ranges. People talk about the yield curve, so I have it in here. I don't think it's that important today. The yield curve is not uninverted. That it was the longest period on record of having the most consecutive weeks of an inversion. What does it mean? I don't know. Yeah, so I'll at least be honest with you. I don't know, but it is a record, so I have to show you. The market doesn't think inflation is here to last. This is something called the break-even spread. Notice the 5-year rate of inflation the bond market is pricing. You can trade this risk today. The bond market thinks in the next 5 years, you'll get a 2% inflation rate. So we're going back to target. Our next 10 years, it'll be 214, 216 over the 30 years. So the bond market has settled back down. They believe the disinflationary trends are underway, and then we're going to go back to that kind of more benign inflation environment. We get a lot of questions about the dollar. Dollar tends to be correlated to rates. If you look at here, I have the 10-year treasury in blue. I'm sorry, 10-year treasury in red. I have the dollar index in blue. They kind of trace each other, right? Because it's interest rate differentials. We have one of the highest interest rates in the developed world. And so that makes the dollar typically a bit stronger in those scenarios. Lastly, what I show here, and I promise no math, this is actually statistics. So Mo, don't call me a liar because I think they're different branches, right? But this is what we call a box plot or the box and whisker charts. What it shows is the range of yields over the last 10 years for each of these segments of the market. It shows what the average rate was over those 10 years, and it shows what the current rate is. Notice, every single asset class here has an above average yield. Okay. Notice some of them have dramatically different. What is that CMBS thing? Oh, those are commercial real estate loans. Oh, maybe there's a little bit of stress in that market, right? So, but what you see here, look at this. You can buy a little high yield. And again, these are a little stale because the rate move in the last week with spreads coming down a little bit, but you can buy a high yield at 7.5. I don't love it, but I don't hate it, right? I'll own a little bit in a portfolio. Emerging markets don't make a lot of sense to me at 6, 7. When I can buy US rates and pull it back together, we're very underweight EM because I just don't think there's a accommodative story when we have yield in our country today. You can buy things that are floaters. Those will come down over time, the leverage loans. But notice the things on the left. These are the safest assets in the fixed income market. These are the treasuries, the government guaranteed mortgages, the investment grade corporate bond market. And look at the yields they give you. Even today, the investment grade corporate bond market gives you roughly what you can get from T-bills. And by the way, if rates come down, you will make more than the yield, right? Because the rate will come down and it reprices and you get a better total return. So in general, as we canvass the landscape, and look, we have sector specialists. I've got 95 people sitting up above me, the floor above me. That's our trading desk. We have sector specialists in each one of these areas that work day in, day out to find the best opportunity. This is just index data. So what I'm saying out there is that I think it's a world, again, I'm biased. I will admit my bias. I think you have to be active in this market today. I think you've got to have an expertise in these areas. You can't just blindly throw money at it because it looks cheap. You have to be careful. You have to be diligent, and you have to underwrite all the credits. And it's extremely important as we get to the stage in the cycle, if things are softening, credit underwriting is going to be the most useful skill set to have for a bond investor. And so, again, do it yourself or hire someone to do it. You don't have to hire us. You can hire plenty of funds on the platform and plenty of great managers out there. But it's one thing, if you're not doing the homework on this stuff, you need to outsource it to some people that do it, and you can generate a better rate of return, hopefully through a cycle. And what our team tries to do with similar or lower volatility than the overall market. So Mo, let me just wrap my comments there. I'll leave this chart up. I'm sure there's a few questions out there. I see you going back and forth, so you've been aggregating. So let me know what's the top of mind. I'll do my best to address it.
All right, so before we get to the Q&A, just 2 comments. Well, 3. One, your enthusiasm is amazing, and this presentation was fantastic.
Thank you.
The other point is I loved how you started, let's generate income and have fun. I don't think any of us were thinking that way last week, so appreciate that. And I do apologize for keeping you and me and your team out of compliance jail, even though it gave you a little bit of old data. So,
hey, well, the goal is to always stay out of jail, Mo. All of us need to do that every single day. So we have a culture of compliance. We are wedded to it. So I I'll take stale data over a week over having issues. So
And that's a good thing. So, all right. So are you ready? Do you need
I'm
to
ready.
take a sip of water or anything?
Sure, let's do
Yeah,
it.
let's do that. Let me ask Kevin. Asked, U.S. debt had had little effect on bond markets, but percent of debt repayment is becoming an issue. Please comment on future of bond markets due to the national debt.
Well, it's the $30 trillion question, Kevin. And I mean, at the end of it, it's really tough to say because we've been able to absorb supply. And don't forget that of that debt, approximately 4.5 trillion of that sits on the Fed's balance sheet. Why is that important? Well, the Fed has a balance sheet. When they buy the treasuries, they create a liability stream. They buy the treasuries. What do they do with the income? The Fed's not a company. Guess what they do with it? They give it back to Treasury. So what that actually means is every single one of those bonds that sits on the Fed's balance sheet is financed at a number of 0. So that's actually helping us a little bit. Now, I only bring this up because it is moral hazard to think the Fed bails us out. But there are other developed world countries that have a meaningfully more problem where the revenues go to a bigger share than the US. And most people would say Japan, right? That's a place to start. A lot of the European economies as well. And so it's a zero-sum game, or it's a relative game. And so it is disconcerting, the willy-nilliness of our elected officials just to pass things left and right. And there's never a conversation about austerity. It's maddening to folks like us. That said, you'll know it's a problem when the bond market tells you it's a problem. It'll look like October of 22, when the UK government, Liz Truss was in charge at the time. She said, we're going to combat inflation by cutting. We're going to do quantitative easing. We're going to stimulate. That's going to help the inflation. Okay, maybe not. And we're going to cut taxes, right? Two things that just, they will create more inflation. And so the bond market revolted. Yields went up like 120 basis points in like 4 trading days, right? The bond market said, no, you are not. And that's when you'll know. Unfortunately, Kevin, it'll be a little late, but maybe that will wake up, our elected officials at some point. But so far, it hasn't been a problem. I'm most concerned once we see another recession. Because what we saw in the last one, and granted, the pandemic is a weird thing. We told people don't work, don't pay your bills, here's money. But they realized how fast you can get it done. By the way, the plumbing is set up to do it again. If you remember what took so long to get money in people's hands, it had to go through the banking system. It went through JP Morgan, it went through Wells, it went from B of A, right? Now it's set up. So the fear is that we do it big, we do it fast, and then the inflation impulse is there. And that would be my biggest concern, Kevin. So I don't think it's a problem for, the next 6 to 12 months, absent some kind of really big lapse in the economy. But that is when my antenna will go up, and we're going to really scrutinize what's going on in Congress more than we normally do.
Well, that's a good thing. Dave asks, with CD and annuity rates going down, where do bonds fit in his portfolio?
Yeah, I mean, look, annuities have been great if you get a new policy. Fixed rate annuities have been really good in this environment. By the way, those insurance companies come to us to invest that money for you. They play the game of doing that. So we're very familiar with that. But bonds can augment this. Again, the annuity, you get the tax deferral benefits. But look, if you're generating a 7-8% return, you can pay some taxes on it and still be better off than that annuity stream. You do have to take a little bit more risk. But remember, that insurance company is not giving it to you for free, right? They're paying you a rate. They're investing in a portfolio. They're hiring managers like us on the institutional side to invest that money, and they're keeping the difference. So if that's what they're doing, that means some of these things belong in your portfolio too, right? So I like the annuity stream. I think it's a great thing. I like T-bills, but it's time to start rethinking that. And it's time to just start peeling some off. And again, you're never going to get the timing perfect, but it's time to go back to basic principles of diversification.
Excellent. Thank you for that, Jeff. Francis asks, with interest rates poised to go down, what strategy should bond investors pursue? Short, intermediate, long-term, tax-free muni, or high yield?
Wow, they give me lots of choices. So the one that will probably perform the least would be the short-term funds. And that's because there's a measure of interest rate sensitivity. And if they're short, they don't get as much kick when rates come down. The opposite of that trade is the long funds. They move really meaningfully with interest rates. So if rates go down, and if you own something like TLT, which is the 20 plus year index ETF, that, by the way, there was massive flows in that in the last 2 weeks. If you own that and interest rates go down, let's say 1% on the long bond part of the curve, you're probably going to make 15, 16%. But on the short end, you're going to make like 1.5, right? So that's the difference. But also, if rates go back up 100 basis points, you're going to lose that. And you're going to lose on the other side. So rates seem fairly priced to me. So I think that there's nothing wrong with owning a little bit of each. And if you're wrong on one of them, you can always either try to buy a little bit more of that one. But I think this is like a belly of the curve. It's an intermediate type market. Munis are always nice because we don't have to pay Uncle Sam at the end of the year. But muni yields are very tight. They've been very tight because people think tax policy is going up too. So they're willing to pay more for them. And they've just been a great trade the last year. So I think the attractiveness of munis is some of the least it's been. And high yield is an intermediate type product. And your yields will go down, but you'll still kind of make a little bit more on the income, and you'll still have that same behavior to some of the interest rate components. Now, the only nuance there is that if rates are going down because of economic weakness, high yield will be your worst performer of all of those, right? So that's why I say we're preaching a bit of diversity. I don't know where interest rates are going this week, this month, this year, right? So we're trying to have the best way of balancing these risks out. And if you look at our portfolios, a lot of what we have short credit, like not shorting it, but short tenor, short maturity credit. We have some intermediate stuff that's kind of like half the portfolio. And we own some very long stuff in treasuries for the what if things go really poorly. So that's how we're running our own portfolios for our clients. So I think that's the way to think through it, that you never want to be all in on one of those trades, unless you're clairvoyant. And if so, give me a call and let me know, because we have a job for you.
Thank you. I hope that was helpful, Francis.
Yeah.
So Alvin asked, and this is kind of a high yield bonds, back to what you were just speaking about. What is the correlation of high yield bonds for the movements of the stock market?
It's the highest of really most of across the fixed income sectors. It exhibits the highest correlation. So when you kind of look at longer term data, that correlation number is like a 0.6, 0.7 in those, and definitely in panics, they're very correlated, right? They're very correlated during a panic. So you have to, that's why there's nothing wrong with owning some high yield bonds. Like there's a reason they exist, and they pay. You're going to have some defaults too along the way. They're riskier companies. So you have to think about that in your income. But it's also, you don't want the high yield to be the complement to your stock portfolio, right? Because you don't get that risk benefit in there. So again, it's understanding that if you think about high yield issuers, they're the most economically sensitive too, right? And just like the stock market.
All right, so are you ready for one more?
Yeah, one more.
All right, so Megan asked, it was just posted this morning that inflation has hit the lowest level since spring of 2021. Do you think we'll likely see rate cuts coming soon?
Yes. I think the Fed is going to start cutting rates in September. The market has it priced. The market says that interest rates will be 1% lower on T-bills / Fed funds by the end of the year. I don't know if it's 0.75% or 1%. I don't think it makes much difference from an economic perspective. But what that tells you is that your cash rates are going to go down, right? And the bond market is telling you they are going to go down. Now, the bad news is you could have bought some other things a couple of weeks ago before this pricing got into the market. But that being said, you could still put together a high quality portfolio that gets you a similar yield to where T-bills are today, We have a bunch of high quality portfolios that try to be on the lower end of the risk spectrum that throw off 5 to 6%, right? And it's a diversified portfolio. So I think the Fed cuts, and they're going to start cutting, but I don't think they're in a hurry to like slash rates 2 or 3%. But I think they're going to get on that measured pace and start to move forward, especially with the inflation data that came out today. The only bad thing in that, Megan, in your inflation report was that the big driver in there is still shelter, right? That's what's driving it. So maybe that's a little artificial construct. So maybe it is indeed lower than we actually think too as well.
Jeff, this was fantastic and so much fun. So appreciate this educational hour. Thank you again. And thanks for all of you joining today. We know your time is valuable. Please make sure you let us know your thoughts of the webinar today in the Q&A tool. And as a reminder, we have several other great webinars like this one coming up. Find them at www.fidelity.com/webinar. We'll look forward to seeing you in future webinars. Until then, stay safe.